Okay, I think we are recording. So, welcome everyone. Good afternoon. It is right now 3:30 p.m. Sunday, April 9th, and today we're finally going to be finishing up the discounted cash flow valuation model that we have been working on for the past 2 weeks, give or take. This might be the final video, or I might record one more after this, depending on how much content I can squeeze into this one. But before we continue with where we left off, I wanted to give a short recap of where we are. And before we do that, let me just say, I posted the video on the weighted average cost of capital on how to calculate the WACC a couple of days ago, and I hope that if you haven't already, that you've gotten the chance to watch that video and maybe follow along on your own with another screen. Doing the Excel on your own, I think, really helps, but I recorded that video so that I could go slow and I could explain all of the details, and that you could replay, pause, continue, rewind, fast forward if need be, so that your understanding is at its optimal level. So now we're going to do the exact same. So I hope that you've caught up with where we are right now. But if you haven't, no worries whatsoever. If you're just waiting for all of the recordings to come out and that you can do it all in one go, that is totally fine. Although I recommend that you get started for the stock pitch competition, which we have coming up soon. I believe it's next weekend. So if you want to follow along, please have the Excel up. I'm not going to be covering how all of the cell references here in the unlevered free cash flow schedule or the WACC. We're just going to be moving on ahead. I'll do a quick overview. But if you want to follow along, have the Excel workbook up and also have the fact set up. Have fact set up if you have it. If you don't, I also recommend having maybe Yahoo Finance, maybe Wall Street Journal market data, CNBC market data, and whatever other resources we have used for the model so far. So the model, it is pretty expansive and it looks a little intimidating, and I totally understand that, but I think if you look at it from a high level, it's somewhat simple, where we have two pieces that we needed. We have a stage 1, which is the future projection of 5 years. And then we have stage 2, which is the terminal value, which is what we're going to be getting to today. We're going to be calculating the terminal value. We're going to be discounting the stage 1 free cash flows. So we had to first project out 5 years of free cash flows. And to do that, we started with revenue. We got down to NOPAT. We made some adjustments to NOPAT, and that is how we got unlevered free cash flows for the next 5 fiscal years. And these are just our stage 1 cash flows, but in order to discount them back to the present, we needed an appropriate discount rate. And in the last recording, we went into extreme detail about what the weighted average cost of capital is, why it is the appropriate discount rate for a corporation's free cash flows, and how you actually calculate the WACC. So if you're curious about the details about either of those two pieces, either the free cash flow schedule or the WACC, go and watch those recordings. But today we're going to be moving on to the namesake of the model, discounted cash flows. So we're actually going to be discounting the cash flows today. It's finally here. So the first thing that we need to do is we need to establish a valuation date, which we have. The valuation date is today. Technically, this valuation date has been getting later and later and later throughout the year because it's taken a long time, but assuming that you did the entire valuation in 1 or 2 days, this probably wouldn't be changing as drastically as we have been doing it. But so the date that we're actually valuing it is 4/9/2023, which means technically we have projected these cash flows as if we were valuing it immediately at the end of the fiscal year of 2022 for Coca-Cola, 12/31/2022. But in fact, we're valuing it to today. The reason that this is important is that from 12/31/2022 to April 9th, 2023, Coca-Cola has still been operating as a business, and it has still been making beverages or making all of its products, and most importantly, it's been selling those products. Coca-Cola has been generating cash in between the end of the most fiscal year and now when we're valuing it. So there is some cash that Coca-Cola has already generated that is already part of its value that we cannot be valuing because it's technically in the past. What we need to be doing is only focusing on the cash that Coca-Cola will be generating in the future. So that is why we are valuing to today, and we're going to be using this thing called a stub percentage. I'll explain what that means in a second, but let's fill out some basic information. So you can now scroll down to the discounting cash flows section of the model. So we have our valuation date, which is today, and then we have 5 years of projections in the future. So the date that we're going to be using for discounting, the present day, is going to be our valuation date. Okay? Now, for the years, you can just do a direct cell reference up to the dates up here. These aren't just numbers, these are actual dates, I'm pretty sure. Control R, and if I do Control C and then Alt EST, that will get us to the actual dates for those. So now I'm also going to format these a little bit. I'm going to center them and give them some underlines. And should I bold them? Let's see if that looks, yeah, I think that looks okay if we bold them. So now what we actually need to do is we need to stub adjust these cash flows. Well, why do we need to do that? Well, what is the stub percentage first and foremost? Well, this is a very special cell. I'll just quickly Alt HBS, format this. So this stub percentage is going to be equal to the percent of the year that's left in order to discount. So again, what does that mean? Well, what we're doing is this is how much of the year is left for Coca-Cola to actually be generating future cash flows. So we calculated that Coca-Cola was going to be, they were going to generate $10 billion of free cash flows in the year 2023. But assuming that they generate cash evenly throughout the year, that means they really only have 73% of the year in order to generate these cash flows. And they're not compressing all 10 billion into the period after April 9th. So when we stub adjust these cash flows, just the year one cash flows, this is going to show us how much cash do they really have left to generate, and they only have about 7 billion. We're not going to do this adjustment for all of the future years because those future years, well, they're still in the future. Our model is capturing the full cash flow generation of the full years of 2024, 25, and so on. So for the other years, we're just going to do a direct cell reference without stub adjusting them. It's just this first year where we need to stub adjust. Okay? So now we get to the present value factor. So if the easy way to explain this is the present value is equal to, and I'm just going to sort of just going to type this out. We're not actually going to be doing this in the model. But the present value of any asset is going to be, the future, it's the present value of its future cash flows discounted at a certain discount rate, right? So that's going to be some cash flows, and then imagine right here that, Alt HBO, imagine that that's like a division sign, and then you have 1 plus R raised to the power of 1, where this is the discount rate. R is the discount rate. And then you have cash flow 2, and then you divide Alt HBO, and then you divide this by 1 plus R, You raise that to the second power, and you would add these two. It's showing, yeah. So here, oops, you would add these two, right? So if you only had 2 years of cash flows. So what we're doing is we already have the cash flow piece. So although we could do this whole operation in one go, what I like to do is, well, the present value equation is equal to some cash flow divided by 1 plus the discount rate raised to the first period. It's the same thing as the cash flow multiplied by 1 divided by 1 plus r. And that is known as the present value factor. If that didn't make total sense, don't worry about it. I need to delete these borders, Alt HBN. Okay, so the present value factor is going to be 1 divided by 1 plus, actually I'm going to get 2 parentheses here, 1 plus, now we go over to our WACC, this is the appropriate discount rate that we've been using, and make sure to lock this reference because this is the same WACC that we're going to be using for all of the years. And now what power do we raise it to? Well, if we just do 1, it's a little bit inaccurate because, well, okay, this is showing is 0.95. Oh boy, oops. Sorry, this is what happens when you need to adjust these years. So over here, it needs to be 2. Oh man, it did it to this one, didn't it? And then over here, it needs to be 2. And let's see, now can I drag it out? 1, 2, 3, never mind, it's only doing it. 3, 4, you kind of get the point here. But the period is increasing, 1 to 2 to 3 to 4. But this is a little bit inaccurate because the whole year is not passing by. Again, only 72% of the year is passing by. We need to discount it today. If we were doing a whole 1, that means we were discounting all the way back to 12/31/2022. So the way that we fix this is we can use the year frac function again. So how did we get this percentage? How did we get the stub percentage? We use the year frac function to say, what is the percent of the year left between today's date and the end of the year? And it says 72%. So we need to actually discount by 0.7278, really. So the way that we can do that is it's a very simple formula. 1 divided by 1 plus, grab your WACC. I'm going to grab the WACC here, function F4 to lock that. Now we can raise it to the power of year frac. We can use the year frac year frac function. Grab today's date as the valuation date and then lock that. And then the end date is going to be year 1. And then close that and then close that. 0.96. See, it's a little bit higher because our date range is a little bit smaller. And now we can control R that through. So look what's happening. Now it's specifically discounting to today. And this is why we needed this array of dates up here. Let me just show what year frac is and how that works. So year frac, if we do it to the start date today and then we do this over here, and let me just make this Alt H, let me just, oh boy, there we go. So now look at what's happening. If I were to make this 12/31/2022, now all of these are perfect, right? Because they're perfect years. 1, 2, 3, 4, 5. So if we were valuing Coca-Cola on 12/31/2022, we could simply just do 1, 2, 3, 4, 5. But because we're valuing on a date other than 12/31, now all of these cash flows are being properly discounted to today. And that also affects the future years, because if this date means that there's 72% of the year left, that means the end of, so if the end of 2023 is 72% of the year left, that means the end of 2024 is 172% of the year left, and the end of 2025 is 272% left. It's all discounting back to today. And that is why the use of the year frac function is very important here. So make sure that your present value factor includes the year frac function. It's a little bit more accurate. Technically, you could do it all to 12/31/2022. I just like to be pretentious about this. So the present value of the unlevered free cash flows is very simply the stub adjusted cash flows. For the first year, it's just a full cash flow projection for the future years multiplied by the present value factor. And that's it. So now we've taken future cash flows and we've multiplied them by their appropriate present value. So what does this number mean? Like, what does this 9,847,000,000 mean compared to 11,466,000,000? 11 billion here means this is how much cash Coca-Cola is going to be generating in the year 2025. But 11 billion in cash in 2025 is worth 9.8 billion today. That is what this means. These are not future cash flow projections. These are present value. These are present cash flow values stated in the year that they're going to be generated. Okay. So this is what we're looking for, but we're not done yet. I wish we could just add this all up and say that we're done. But this only gives us how much cash the company is generating if we added all of these 5 years up. That would only give us the value of the company if we knew that Coca-Cola was only going to be operating for the next 5 years. In fact, Coca-Cola is going to be operating for a lot longer than that. In fact, corporations are assumed to operate into infinity. So what do we do about the cash flows for all of the years beyond 2027? Well, here's where we have to calculate a terminal value. And there are two basic assumptions. There are two basic ways that you can go about calculating the terminal value. I'll start with the Gordon growth model and then we'll move over to the EV to EBITDA multiples method. But what this means is both of these models have one goal in mind, finding the terminal value. And if you remember from our DCF overview lecture where I wrote this out on the board, the terminal value is going to be a big lump sum of cash. It's the present value of all of the cash that Coca-Cola will generate from the last year of our projection period into infinity, all discounted back to 2027. Okay? So after this, we're probably going to have, I don't know, let's just say it's like 100 billion. So this 100 billion amount is going to be all of the cash in the future, but it's going to be discounted to 2027. So really I should show it like right here, because these two values, so this 9 billion is the cash generated in 2027, discounted back to the present. And this cash is, actually I should probably show it up here. Yeah. So this cash is going to be this, let's just say it's $100 billion. That 100 billion is all of the cash that Coca-Cola generates into the future after 2027, discounted back to 2027. And that we need to discount to the present. But how do we actually find this terminal value? So there's two ways of doing it. The first is using what's called the Gordon growth model. The Gordon growth model is pretty simple. What you do is there's an equation for it. So that equation, I'll just put it in right here, is the free cash flow in your year 5 projection multiplied by 1 plus some terminal growth rate divided by your cost of capital minus your growth rate. Minus your growth rate. So now, if you want to understand where this equation comes from, you can look at convergent and divergent series. This has to be a converging series though. But this is the equation for it. This is the equation, and what this equation is going to give us is the terminal value of all future cash flows in 2027. So the first thing that we need to do is we need to we have most of these numbers. We have the free cash flow in year 5, that's this number. We have the free cash flow in that's this number right here specifically. Then we need to, and we also have our K, we have our WACC, that's the cost of capital. But what we don't have is we have a discount. We don't have a discount rate. We don't have a growth rate. We don't have a long-term growth rate to plug into this model just yet. But we can, this is where you just estimate it. So the law for the long-term growth rate is that it has to be less than the country's GDP growth rate. So the GDP growth rate right now is, I think, like 2 to 3%. You can also look that up. But this number has to be very, very low, because if it's too high, first of all, it cannot be higher than your WACC. Because if it's higher than your WACC, then some crazy stuff is going to happen with the math. It just cannot be higher than your WACC, and it also should not be higher than the GDP of, it should not be higher than the GDP growth of the country, because that's assuming, what that means is that the company's cash, there's a lot of C words coming up in this sentence, the company's cash is going to outgrow the pace of the entire economy to the point where Coca-Cola is the whole economy. That's never going to happen. So your growth rate has to be very small, usually 1 to 2%. But because Coca-Cola is such a stable company, I'm going to project even lower than that. I'm going to say it's going to be 0.5%, and I might even adjust this to 0.1%, because I really don't think that Coca-Cola, because it's such a stable business, I don't think its cash flows are going to grow very much. And this is something that you should tweak. I would say throw out a very low estimate initially and see what number comes out. And then you can tweak it based on, if it makes sense, right? Okay, so this is just our estimate. Again, this is just an estimate. Now, what we do is we take our 2027 unlevered free cash flow over here, 12 billion, and we multiply it by 1 plus this growth rate. So let's go over here, multiplied by 1 plus the growth rate. Okay, so it's 12 billion and some change. So now we can calculate a terminal value in, this says 2024. So that is incorrect. This should actually say 2027. Right? Same here, it should say 2027. This should be the present value, the terminal value is the present value of the future cash flows in the last year of your projection. So this year specifically might change depending on when you're actually doing the model. So you can divide this number, this is our FCF 5 times 1 plus G, divide this by your WACC minus your growth rate estimate. Boom. And it turns out to be 230 billion. Okay. Just make sure that it's capturing the proper cell references. Pretty sure it is. This is a massive, massive amount, by the way. So now the present value of our terminal value. So let's do the present value of the stage 1 cash flows first. So this is just going to be the sum of these that we calculated. So it's 49 billion. But remember that this terminal value is in 2027 right now. We need to bring it back to today, right? So what we can do is, because this is in 2027 right now, we can take this number and we can multiply it by our present value factor in 2027. And that gets us to 176 billion. So our total enterprise value is just going to be the sum of these two. It's going to be $222 billion. So let me actually just make a quick border for that. Show that this is what is being calculated right here. $222 billion is our total enterprise value. So now we have essentially gotten the final answer for our DCF. The enterprise value is the final answer for the DCF. And we can take this value and then we can adjust it to get our share price. But there's another way to get the terminal value, and that is through the multiples method. So the way that a multiples method is going to work is you look at enterprise value to EBITDA multiples of similar companies to Coca-Cola. So the ones that come to mind are like Keurig Dr. Pepper and Pepsi, some others. And what you do is you look at the industry average EV to EBITDA multiple, and then you multiply Coca-Cola's last year EBITDA by that average multiple, and that will also get you the terminal value in 2027. Again, it's a little bit weird, but think about it like this. If you have an EV to EBITDA multiple, right? And if you multiply that by an EBITDA value, what are you getting in the end? You're getting EV, right? Because the EBITDA in the numerator and the EBITDA in the denominator cancel out. So what you're getting is an estimate of EV. You're getting an estimate of enterprise value. That estimate of enterprise value is the terminal value. And then we can discount that to make it the present value of that terminal value. And then we can add that to the present value of our stage 1 cash flows to get our total enterprise value. Hopefully that makes sense a little bit. So what is our terminal year EBITDA? This is why we calculated EBITDA up here in the unlevered free cash flow schedule. So this is our terminal year EBITDA, 2027, 16 billion, right? Now we need to get the EV to EBITDA multiple. So this is a little bit complicated. It's actually not too complicated, but we're going to need FactSet for this. So what I want to do is I'm going to open up a new sheet. I'm going to call it comps. Alt PVG. And now we have to ID our comps first. So we're going to say comp, ticker, and then EV to EBITDA. So these are just some, let's be pretentious about it. Oops, Control B. There we go. So now, show I, there we go. So now we're going to get comps, we're going to get tickers, and then we're going to get the EV to EBITDA. So what are some comparable companies for Coca-Cola? Well, luckily, I'm going to move this over to the beta. Yep. So luckily, FactSet does it for you. So if you're on FactSet, go to Coca-Cola, go to snapshot, and here in overviews, you can go to comps. And this is really nice. So automatically, FactSet will generate comparable companies to your target company, right? So Coca-Cola is our target. So here's where we can modify peers, and I recommend doing this a little bit. So instead of using FactSet Revere, I recommend using the RBICS subsector, just to be a little bit more. Try not to use all named competitors. You want to use competitors that are actually competitors of Coca-Cola. And you only want it to be in the target's country. So these are the three criteria for good comps are it has to be in the same industry. They have to be in the same location, so same geography, so that they're working with the same markets, the same total addressable markets. And they have to be roughly the same size. Usually that metric is market cap. But Coca-Cola is massive, so you have to be a little bit, you have to stretch the rules on that market cap range a little bit because there's only one company similar in size to Coca-Cola, and that's Pepsi, right? So let's look at, food and beverage production, that seems like a good industry, only in the target's country, the US, and market cap range, it does that automatically. And look at that. So it just calculates comps for you. So now, selected financials. So let's look at what comps it spits out. So Coca-Cola itself, Pepsi makes sense, Mondelez International, and really you only need 5 to 6 comps. So Mondelez International, haven't really heard of this company, but I'm sure that they're important. Monster Beverage, General Mills, Keurig Dr. Pepper, Kraft Heinz. I'm going to take out Constellation Brands because this is by far the smallest. And let's look at market cap. So if I 1, 2, 3, 4, 5, yeah. So I'm gonna take out Kraft Heinz too because it's under 50 billion. Okay, so now we have ID'd our comps: PepsiCo, Mondelez, Monster, General Mills, Keurig. And what we're gonna do is it also gives us valuation multiples. So it gives us EV to EBITDA multiples for all of these 5 companies. And we can take an average of those, or we can take a median of those. So let's get them. So PepsiCo is the first one. Actually, let's see if I can just copy these. Control Shift Alt ES. I want Unicode text, please. Okay. Totally fine. All right, and now let's get these tickers. Actually, I might just Control C, Alt ES, Unicode text. It's totally fine. So I'll just do this. This is Pepsi, MDLZ. I'm being pretentious. MNST, GIS, Keurig Dr. Pepper. Alt HAC. Okay, I'm gonna make this a little bit wider. Got 25. Alt HAC. And now we can grab these EV to EBITDA multiples. So I'm gonna take these 5, Control C, Control Shift V. Oops. Alt ES, Unicode text. So are these numbers right now? I'm gonna convert them to numbers. Yeah, and get that into X format. So now let's get averages. So the average of these multiples is going to be 22.31. So that is our this is going to be our industry average EV to EBITDA multiple that we can use. So over on the DCF model, our average EV to EBITDA multiple is going to be 22.31 that we calculated right here. And we can do a more rigorous comps analysis. 22.31. And now what we do is we can take our final year EBITDA, multiply it by this EBITDA multiple. And that gets us to our terminal value in 2027. Again, we can multiply this terminal value by our present value factor in 2027 to get the present value of this terminal value. And then grab the sum of our stage 1 cash flows. And the sum here is going to get us to our total enterprise value. So the first thing that you notice is the long-term growth rate here at 0.5%, 222 billion. Here it's 324 billion. So what I'm going to do is I am going to go and find out what the share price is, and then maybe we can make some adjustments to this growth rate or this EBITDA multiple, because it seems like either this growth rate is too high or this multiple is too large. And it's probably being propped up by this Monster beverage multiple right here, which seems to be heavily overvalued. Maybe if we were just doing the average of these two and then these two, yeah, 19.98, and that is probably going to severely desensitize. Yep, right. But let's keep it to the average because Monster is an important competitor, comparable company to Coca-Cola. So now we have our terminal value. We have our total enterprise values using the two methods. How do we actually convert these enterprise values into share prices though? So the first thing we need to do is convert enterprise value to equity value. So if you remember the equation over here, enterprise value is equal to equity value plus net debt, right? So what is net debt? Net debt is all debt-like items minus all cash-like items. And if we subtract net debt from enterprise value, that gets us to our equity value. So let's actually get that. So how do we calculate net debt? Over here, I'm going to make a quick border. So our long-term debt, start with our long-term debt. I'm going to make this add long-term debt, sorry. So the company's long-term debt, we can go to our statements. The most recent long-term debt is right here. 2022 preliminary long-term debt, 36 billion. Short-term debt is going to be both these loans and notes payable on 73. So I'm just going to go over there, plus any current maturities of long-term debt. Boom, 2.772 billion. You could also get this number from this book value of debt technically, but I'm breaking it out just to show the debt profile of Coca-Cola. Okay, let's just make sure that we're recording really quickly. Okay, so after we grab our debt items, now we can grab our non-controlling interests. Let's just see if they have any non-controlling interests. So yeah, they do actually. Equity attributable to non-controlling interests. So this is a debt-like item that needs to be subtracted from enterprise value because this is these are investments that are not part of Coca-Cola technically, or they don't belong to Coca-Cola shareholders, which is why they need to be subtracted from total enterprise value. Okay, and preferred stock. Let's see if they have any preferred stock. So total equity, common stock, capital surplus, reinvested earnings, treasury stock. Okay, I don't think they have any preferred stock. So what we can do is we can just say 0 right here. So now cash. So let's go to cash and cash equivalents and short-term securities, short-term investments. So that is what total cash and cash equivalents is going to be. So 10.562 billion. You could also take the sum of these two, I suppose, but I'm just going to get the subheader right here. And marketable securities, because these are also very liquid investments that could be converted to cash. And we explained all of this in our enterprise value and equity value lecture. So our net debt is going to be the sum of these items from preferred stock to non-controlling interest, short-term debt, long-term debt, minus the sum of all cash-like items. 23.239 billion is our net debt. So now we can go over here to our final valuation. We're almost done, people. So implied total enterprise value. So we'll notice we can compare these two values for both the Gordon growth model and the EV to EBITDA model method. Sorry. So over here, let me calculate. So our implied total enterprise value for Gordon growth is this 222 billion. Our EV to EBITDA was over here. Let me make all of these centered. Okay, it's not doing it. That's totally fine. Our net debt is right here, F4, because that's going to be the same in both. And we can subtract our net debt from our total enterprise value to get our implied equity value. Noticing that they're very different right now, but that's totally fine. So now what is our share price? So this is our market cap. This is what we calculate the market cap of Coca-Cola to be. Really quickly, if we go up here, we notice that the market cap is 4.327 billion. And their market cap is that's 271 billion. And here with Gordon growth, it's saying that it is less than that. With EV to EBITDA, it's saying it's more than that. So we're going to have to smooth this out a little bit. So our implied share price is going to be this equity value divided by, it's going to be that divided by our shares outstanding. But if we do that, we are over dividing because this is in millions while this is in actual numbers. So we need to take this and we need to divide it by 1,000,000. Boom. Oops, sorry. I need to lock that reference, don't I? Yep. And we can convert that into currency format. Oops, I'm messing up my shortcuts here. Control-Shift-4. There we go. Let's bold that. So these are implied share prices. Now, our implied upside in dollars is what is the current share price, what is the implied share price minus the current share price. So let's update this current share price because it might be different trading day. 62.84. 62.84. It says that right here, by the way. So we take this price, our implied share price, minus the current share price. Lock that. So you'll notice that it's less for Gordon growth and a little bit more for EV to EBITDA. I'm probably going to increase this estimate because 0.5 is a little low. And our implied upside downside percentage is equal to this number divided by your divided by the current share price. And we'll convert that into a percentage. I'm going to make this not, I don't know if I'll make this red or not. We don't need to worry too much about formatting here. Or I'm going to make this all PJ. Let's see if it looks better in accounting format. I don't like it too much. Okay, so it's showing downside. Alt HP. Okay, it's totally fine. That is totally fine. That's totally fine. So we're showing significant downside if we use the Gordon growth model and pretty good upside if we're using EV to EBITDA. So I'm going to increase this growth estimate a little bit. So let's make it 1%. Let's make it 2%. Now we're sort of getting in that range. So I'm going to go 1.5% and say that's a good like medium. So one of these is showing negative. One of these is showing positive. So again, we've kind of fudged the numbers up here. So this is going to give us some random numbers. I strongly recommend that you do both and that you check your assumptions. Here we're getting both answers. Like it's both positive and negative, which means we don't really know. You know, that's totally fine. Like all valuations are incorrect at the end of the day. They're all assumptions. So that's totally fine. So now we can actually do our sensitivity analysis, which is one of the most important parts of any discounted cash flow model, which is how does your final implied share price or implied upside downside, what is your final share price if you change some of these really important factors? So the three most important factors in a DCF, if you remember, the first are your revenue projections. This is important because almost everything in your free cash flow model is based on your revenue projections for the future. The second is your WACC. What assumptions did you use for your WACC and what is the actual WACC value in and of itself? And the third driver of the value in your DCF model is your terminal value assumption, those being your long-term growth rate or your EV to EBITDA multiple. So you can conduct a sensitivity analysis to see if you changed your WACC and if you changed your long-term growth rate, or if you changed your WACC and if you changed your exit multiple, how would that affect your share price? Your final share price. That's very important because we only did a point estimate here. Here you can test a range of values. So let's do that. The first thing that you need to do is up here in this top left corner, you need to reference your share price. So I'm going to reference the Gordon growth because this is the Gordon growth sensitivity table. And this is going to be the EV to EBITDA sensitivity table. And what I'm going to do is I'm going to hide these. So I'm going to make these white. So Alt HFC, and I'm going to make them white so you can't see it because it looks a little bit prettier that way. Alt HFC. They're still there, they're just white font. But now this is free. Okay, so now what you put in here is, so there are 5 cells here. So in the middle, you put in your actual long-term growth rate. So I believe here we said 1.5%. And then here, let's say it increases by, I don't know, let's start with 0.5, or let's say that increases by 0.0, okay, I'm just gonna say 0.5%. And that's 2%, and that's 2.5%. This is this minus 0.5%. And then now it is 0.5. So you want to be increasing, oh boy. Yeah, this is why you use Alt ESF so that it does not mess with the border formatting. And then Control C, Alt EST. That, never mind, that also messes with the, so I'm going to convert these to 2.5% equals this minus 0.5%. Control C, Alt ESF, convert that into a percentage, There we go. So now we have a range of long-term growth rates, and we're probably going to tighten this if it seems a little bit too expansive, which it probably is going to be, right? So we want to be increasing with long-term growth rate because higher long-term growth rates will increase your valuation. But for your WACC, you'll want to be decreasing. Why? Because lower WACCs mean higher valuations. So that means you're going to have the lowest valuation up here, the highest WACC with the lowest growth rate, and you're going to have the highest valuation up here, the lowest WACC and the highest growth rate. So there are 5 cells. In your middle cell, we want our actual WACC. So this was 5.74. So if I was to say go out here, what is 5.74? Yeah, 5.74 seems roughly good enough. 5.74%. So this is going to be decreasing. So let's say it's this plus 1%. Control C, Alt ESF, Alt HP to get that into a percentage. I'm gonna make it like that. And let's say this decreases by 1%. Alt ESF. Get that into a percentage, 2 decimal places. So now we have a range of long-term growth rates and a range of WACCs. I'm going to copy this over so that we have the same WACCs over here, but now we can do the same for exit multiple. So for the exit multiple, we use 22.31. 22.31. Oop, that is not the right format. It needs to be in the X percentage. There it was. There you go. 22.31. So let's say plus minus 1. So this plus 1. There we go. Control C, Alt ESF. Get that into X formatting. You don't really need to worry about the X formatting here. This minus 1. And Control C, Alt ESF. Yes, and I have 20.31 to 24.31. Add a decimal place here and make these the X formatting. There we go. So now we have a range of WACCs, a range of growth rates, and a range of exit multiples and a range of WACCs over here. So how do we actually do the sensitivity table? This is really cool. And what I'm going to do is I'm going to move my camera so that you can see what I'm doing here. So you want to open up this bar right here. You're going to open up the toolbar. So the first thing I want to do is over here, select your table, and then go to Data, What If Analysis, and then go to Data Tables. We're building a data table here. The row input cell is what is changing throughout the row. So that is our long-term growth rate. So go and select here the long-term growth rate. And then our column input cell is what is changing throughout a column. And that is our WACC. So go ahead and select this WACC right here. Say OK. And look at that. So now if we go over here and we convert these into dollars, you'll notice that at our intersection, it equals our implied share price. It's a little bit off because we hard-coded this WACC, and this WACC is a little bit different. It's not exactly 5.74, but it's close enough, right? This middle value, if we can highlight that, this middle value is what we're getting. This is our point estimate, and this is how it changes. And if you want to make this look really pretty, this is what I recommend you do. You select these, you go home, you go to conditional formatting, go to color scales, and look at that. So now it's showing the lowest share prices in red and the highest share prices in green, which is pretty nice. I like that. And I personally like to put a border around this, our center point, to show that that is our point estimate value. So you can go here to borders. So for the cell, you can go here to borders, line color, make it red, and then make that, yeah, and then make that line style a little bit thicker. Let's see. There you go. Shift Alt HB. See, is that going to do the same? Yep, Alt HBN. So make sure to change your presets back to automatic, and then this when you're done with that. But this is a border that we can use to show these are our actual values. And over here, I'm going to do Alt HAC to get those in the middle. There we go. Doesn't that look nice? Yes, it does. Yes, it does. So now we can do the exact same thing right here. So select your data table, go over to data, go to what if analysis, go to data table, go to the row input cell. In this case, that's their EV to EBITDA exit multiple. So select this 22.31. Our column input cell is still our WACC. Say OK. And now we can Control C and Alt EST. And look at that. So now it is showing the conditional formatting. The lowest share price is on the top left, the highest is at the bottom right, and our point estimate of 68.14, 68.15 roughly, is showing in the middle. So that is our sensitivity analysis. And that pretty much does it for the DCF. You can take this a step further by doing a comps analysis. You can take this a step further by doing a comps analysis, and I will show you how to do that. And then you can build out a graph here called a football field chart to show what is a range of implied share prices for if you do a DCF and if you do a comps. And I like that. But this does it for today's section. Actually just finishing the DCF. So this is getting a share price using fundamental valuation techniques, using an implied valuation, is an intrinsic valuation. That is the word that I was looking for. So there's three main ways of doing valuation. The first is intrinsic or DCF valuation. That's what we just did. So to recap, we found our stage one cash flows by building out an unlevered free cash flow schedule. We got from revenue to NOPAT to unlevered free cash flows. Then we found our appropriate discount rate, our weighted average cost of capital, in order to discount our future cash flows back to the present. We did exactly that. We accounted for the date shifting a little bit. And then we found the present value of our stage one cash flows. Now we needed to find the present value of the stage two cash flows, which is the terminal value. There's two ways of doing that, Gordon growth model and multiples method. We estimated a long-term growth rate and an EV to EBITDA exit multiple. And we found our terminal values and our total implied enterprise values as a result of that. For each of these values, we subtracted net debt to find the implied equity value, and then we divided those implied equity values by the number of shares outstanding of Coca-Cola to find Coca-Cola's implied share price. Now, the important question is this a buy or is this a sell? I don't really know, if I'm being totally honest, because right now it's trading at 62.84, and we kind of just made these numbers up, right? So our revenue, we kind of made these up, but we did go pretty accurate with the WACC, and we really just made these Gordon growth models and our EV to EBITDA multiples, although they were an average, right? Now, if this EV to EBITDA multiple was just an average of PepsiCo, Mondelez, and then General Mills and Keurig Dr. Pepper, now it's also showing the red because it's 19.98. So it was showing a positive valuation just because Monster is trading pretty expensively right now. But if not, if we only look at the smaller companies, that sort of pulls down that EV to EBITDA multiple, and now it's showing in the red too. It's showing that it's less, right? And you would probably have to change this too. By the way, for these numbers, you have to hard code them. You can't I don't know why, but you can't just do a direct cell reference. I think it just messes with the way the data table works though. But let's say this was, 19.98.98. So that changes, and now look at that. It automatically updates the data table. But I would probably say Coca-Cola is a sell right now just because it's a very big mainstay in the S&P 500. And the market is going to be very volatile for the next few months. We don't really know what the Fed is going to do with interest rates, if they're going to be increasing them at the May meeting, if they're going to be continuing to increase them throughout the rest of the year. We don't know the probability of a recession right now. It seems somewhat likely. We don't know how oil prices are going to affect Coca-Cola's cost of production. At the end of the day, what we did right here is we just showed you how to build the DCF model. There should be a lot more thought put into your assumptions if you're actually pitching a stock and then building a model based off of that. And you should be much more confident in your assumptions. These are pretty thin. Like the downside here is 12.65% to 2%. That's pretty thin margin. So technically it could go either way. And as you'll notice, so the current trading price is what, 62.84? Yeah. So if it's higher than 62.84, like very, very slight differences in the WACC and in the long-term growth rate will can affect your share prices. Like, so what if we tighten these growth rates up a little bit? Because so right now it's 1.5. Let's make this 0.25%. So let's make these 0.25%. And let's make this 0.25%. Right? So now this is a little bit more, this is a little bit tighter. But I want it to look like this. So let's just make this like 0.1%. 0.1%. Now it's looking a lot tighter. And you can do this with your sensitivity tables to show that the long-term growth rate probably isn't going to differ that much. You could even make it a half, like 0.05% too, if I wanted to be precious about it. But that's pretty much it for this model, folks. You can technically stop here. I will record another video showing you how to do a comps analysis, but this is it for the DCF. So if you can get to this stage, we'll be happy. For your stock pitch, if you can get to this stage, we'll be happy. You don't need, well, actually we highly, highly, highly recommend that you do a comps analysis along with it, and I'll show you how to do that. But, what you need to show us is you need to show us your unlevered free cash flow schedule. You need to show us your WACC, and you need to show us your assumptions for WACC. You need to show us either your estimates for, actually you don't really need to show your estimates right here. Then what you need to show us are your final valuation. So what was your final equity value and implied share price? What is your implied upside or downside in both dollars and percent? And we definitely want to see this sensitivity analysis, because that will show us what point estimates are you using for long-term growth rate or exit multiple, and what is the range of those. You don't have to do the growth rate because this is very, very volatile. I personally would just recommend doing the EV to EBITDA multiple, but I think it's good to do both because this is technically more financy theory based. This is more markets based and what investment bankers would actually use. People would probably use EV to EBITDA multiples over here. But do both, and I hope that this was a good exercise. I hope you all learned something from this pretty long journey that we've been taking. And I'm gonna stop the recording right here, and I hope you all have a wonderful day.